Booyah! Booyah!
Good morning, good evening, and good afternoon, guys. Today we're going to be going over how the stock market works and what stocks are. Let's get into the video.
Booyah!
You're familiar. So if you don't know by now, then you should probably get familiar.
Okay, guys, today we're going to be going over a Forbes advisor article on the investing basics and what stocks are. Okay, so let's get right into this. So stocks are a unit of ownership in a company, also known as shares of stock or equities. So when you buy a share of stock, you're purchasing a partial ownership stake in the company, and it entitles you to certain benefits. Now we're going to go into what stocks are in this article. So companies raise capital to fund operations by selling shares of stock. And when they sell the stock shares, they're inviting investors to purchase a fractional ownership in the interest of the company. And that does make you a part owner of the company. And equity is another word for stock. Okay, so you can say that you have equities in a certain company in the same way you can say that you have stock in a certain company. So that's all equities means. Okay, as it says here, they are an alternative name for stocks. So companies can also issue bonds to raise capital. However, buying bonds makes you a creditor, not an investor, and it does not give you any ownership in the company. Now, when you buy shares of the stock in the company, they can give you certain privileges depending on the type of stocks or shares that you own and depending on what the company is willing to give you. So sometimes you can have voting rights, sometimes you can get dividends, and sometimes you can just have capital appreciation, which means you don't get either of the two above. Now, with the voting rights, you might have the right to vote at a company's annual shareholder meetings. However, this is very rare that you would have enough stocks to be able to warrant being on the board of the company to make actual financial decisions for the company. Now, dividends is another way. You will receive a share of the company's profits. And then capital appreciation is the other one, where you just own the stock, and if the price goes up, you can sell the stock for a higher rate, and if it goes down, you can sell it for a lower rate. But as it says here, while stocks give you an ownership of a share in the company, owning the shares does not mean you're entitled to say what happens in a company's day-to-day operations. And owning a stock means that you trust the company's leaders to run the business in the way that they see fit. And if you don't like the performance of the company, you sell your shares and you choose a different place to invest your dollars. Now, initial public offerings are another way to get invested into a company in the early stages. So when private companies, so companies that are owned wholly by a specific individual or companies that are not public and on the market, so you can't just readily buy the stocks themselves, companies will decide to sell shares of stocks for the first time to the general public. And this is what is called an initial public offering, or most commonly known as an IPO. And when you read that a company is going public, it means that they're conducting an IPO, so they will make shares available for purchase by investors for the first time via public stock markets. Now, when it says public stock markets here, some investors, if you're big enough and you're well known, may be able to get in the very seed funding stages, and then they will make a lot of the money here because they'll be able to sell their shares they got in the private round of investing as opposed to then selling them in the public round of investing that happens when they go public. Okay, but during an IPO, the company will disclose how many shares of stock it will be issuing and then the price as well of the IPO itself. The funds raised from the sale of the stock, they go directly to the company. And once the offering is complete, the shares of the stock are traded on the secondary market, otherwise known as the normal stock market for you and I. And this is where the stocks rise and fall in price depending on a wide range of factors and variables. Now, there are different types of stocks that companies can issue, and they can issue common stock and preferred stock, and there are some others as well, but we'll get into those in a later date. But these two are the most common here, okay? And some of the companies have other classes of stocks as well. These two types of stock determine your voting rights, okay? They also determine your dividend payments and your rights for recouping your investment if the company goes bankrupt, that is. Now, each share of a common stock typically gives holders a single vote at the company's annual meeting. However, common stockholders are at the end of the line after the debt holders and the creditors and the preferred stakeholders when it comes to recouping the investment if the company goes bankrupt. So when a company goes bankrupt, the people who will get their payments back first to recoup their investment money will be the debt holders, the creditors, and then the preferred stock shareholders. And after that, you will then get the common share stakeholders. So you're right at the bottom of the pecking order for getting your money back from the government if the company does go bankrupt. And if these guys here take all the money first, then unfortunately you're not going to get any money back from being a common stakeholder. But common stock, on the other hand, generally entitles you to dividends, so you will get paid out along the way. It will be a small amount, it's not going to be a massive amount, but if you get in early enough and you buy enough shares, if a company does go massive, you can then get back a few £1,000s every month, depending on the size of your dividend portfolio. And these dividends are not guaranteed, as it depends on the company's earnings and their own needs, whether they need the money to fund future investment into new technologies. Now, preferred stock does not give you any voting rights. However, it gives you the entitlement to receive dividend payments before common stockholders. So you have to basically either choose whether you want to receive a dividend payment or you want to be able to vote in the company's interest. However, you will need a hell of a lot of common stock to be able to vote in the company's interest. And sometimes companies don't even hand out common stock. They only give out preferred stock, as they'd much rather be able to give out dividends as opposed to giving away voting rights to the general public. But as it says here, the people who own preferred stock are ahead of those in common stock in line for recouping their investment if the company goes bankrupt, as I said before. Now, the different classes of stocks. Companies frequently issue different classes of stock, often lettered through A, B, or C. And these letters designated to the stock give a specific level of voting rights per class and exist to help the companies retain a greater degree of control over the company. So, for example, with Alphabet, the holding company that owns Google, Alphabet has 3 classes of stock. A-class stock gets 1 vote per share. Now, Class B stock is held by the company's founders and gets 10 votes per share. And B-class stocks are not publicly traded and exist to help the founders retain control over the company. However, C-class stock has no voting rights and is largely held by the employees and some common shareholders. So what happens is that when a company's founders decide to go public, they will be issued B-class stocks and they will get 10 votes per share. So the seed round of investors after that will get A-class stock, so that's 1 vote per share, and that will be given out to the general public after as well. And then C-class stock is given out to employees as a reward for doing well or just for being in the company for a long time. Now, there are different types of dividends as well, okay? So depending on the type of stock you own, companies may share their profits with you. They don't have to, they may do it, okay? Investors receive dividend payments quarterly or annually, and these payments are allocated based on how many shares of the company stock you own. Okay. Holders of preferred stock have priority to claim dividends, as we've spoken about before in this article, and they come ahead of common stock owners. Okay. Regardless of the type of stock you own, the principles governing dividends are the same. So a dividend stock is the same through and through. It doesn't matter whether you're a priority or a preferred, or whether you're a common stakeholder. Now, if a company has a positive earnings for the quarter and issues a preferred stock dividend of 42 cents, if you own 100 shares of the company in the preferred stock, you will receive a dividend in cash of $42. Now, many of the companies also offer a dividend reinvestment plan, or a DRIP plan. Now, this allows you to reinvest your cash into the dividend payments automatically, so you get more stock, so you can get a bigger dividend later on. And this expands your holdings and keeps your cash hard at work. Now, companies sometimes issue stock dividends. If a company declares a stock dividend at 5% and you hold 100 shares of the company, you would receive 5 additional shares of stock, bringing you to 105 shares. However, the value of each outstanding share would decrease by 5%, making the value of these shares the same, as they've added the amount of shares into the system. Okay, so they've added the amount of shares that the company is split between in total, which means that even though you've gained 5% more shares than you had already, the value of those shares has come down altogether. Now, you can also issue hybrid dividends, which are a combination of cash and stock dividends. And now these dividends are rare, but have been used in the past as a way of sharing profits with their shareholders. Now, why do you want to own stocks? Stocks give you the potential to share in the profits of the world's most successful companies. Now, the S&P 500, one of the most common indexes, we're going to get into indexes in the next video on stocks. They track the performance in the US, and they deliver an average of 7% annual rate of return. However, they do not give you a dividend. In the period between 1959 and 2009, there was a 7% annual rate of return, okay? However, when you compare this to Barclays in the US, they only had a return average of 4.67%. So you gained more money from holding the S&P 500 stock as compared to holding the Barclays stock between 1959 and 2009. But that's a long time to hold a stock for, in my opinion. Now buying stocks is also risky, okay? It's not without risk. Investors use stocks as a core tool to grow the savings plan for long-term investing in financial goals, such as retirement and educational savings. So if you started investing at 21 and you worked all the way through to retirement, and you put 10% of your money into the S&P 500, by the end of it, you'd have a large nest egg to go and live your retirement on, okay? And that is one of the founding principles of the stock market. And as the stock prices go up, so does your savings balance. But these prices can also come down quite quickly, okay? And sometimes they lose all of their value and become worthless. And also, there's no guarantee you'll recoup any of your investment, so it is risky, especially if you don't pay attention and keep an eye on the markets. Now, stocks are one of the most basic ways to diversify an investment portfolio, as you can buy different stocks in large companies in a small and wide variety of industries to mitigate the risk, as different sectors thrive at different times, okay? For example, paper products experienced record sales during the economic crisis. However, the automotive industry had a below average sales performance on the basis that nobody was buying cars as they couldn't go anywhere, due to this lovely thing here, which I'm not going to comment on because I will get a strike on my video. However, if you owned a variety of different stocks, you can enjoy the gains in thriving sectors whilst offsetting the losses in others. So diversification means that you are spread across the board and you will most likely go up as a whole even when some of the markets come down. Now the difference between stocks and bonds is kind of vast. Okay, stocks and bonds play a complementary role in building a diversified investment portfolio. And buying both stocks and bonds help investors capture market gains and protect against losses in a variety of market conditions. Now we're going to look at this little lovely graph here they've provided, or this table, and we're going to go through it. So stocks are a fractional ownership of a company, whereas bonds are fractional interest in a company. And with stocks you make money through capital appreciation and dividends, and bonds you get money back from regular interest payments. So with a bond you essentially become the bank. You loan your money to the company and the company will pay you interest back on that loan until they pay back the full loan. But we will get into bonds in a later video, okay? Now the risk and returns on stocks are generally higher, and even with the exchange rates they are higher as well. But they also give you higher returns, whereas bonds are lower risk but they give you limited returns as they do not grow, they are consistent. Now, if you're looking for long-term growth, having more stocks in your portfolio is a good strategy as they're historically high rates of return compared to bonds, especially if you pick the right ones as the economy is growing all the time normally. And public companies try to grow their revenue and profits, otherwise they're not a very good company. And this causes the value of the shares to rise over the long term. However, if you're looking for a steady income, investing more in bonds might be a better approach. Now they have a lower long-term rate of return than stocks, however they are less risky and normally they're more safe as they are backed by the government if something goes wrong. A bond investor is more likely to get their money back than a stock investor, okay? However, a well-chosen portfolio of bonds could offer a reliable interest payments and lower volatility. And this is attractive for investors who might be nearing retirement or who want to preserve capital after their years in the workforce. And that is this article, guys. I hope you enjoyed the video and I'll see you in the next one. Thank you for watching.
I can't even booyah anymore. I can't.